Good morning. This is Larry McMillan with a stock market update on Monday, May 4th, 2020, before the market opens. Well, we've had a couple of nasty down days now after that oversold rally pushed very strongly up above 29.50, but it's fallen back some then. However, it still hasn't reached its rising 20-day moving average. That's still rising, and the market is still above that. So I'd say this is a bit of a tricky market. It's fast. It's makes these big moves sometimes on news, but sometimes not, and it's very difficult to I think trade it on the short term. The SPX chart in the big picture still remains negative because we need to see a pullback from this rally and then see what happens from there. The short term, of course, is much more positive. The modified Bollinger Band buy signal is still in effect, although it's drifted below those bands as well. We should have support around the 2720 level and then below that at 2650. If we were to violate 2650, then I think there would be some further action on the downside. The equity only put call ratios remain strongly on buy signals. This little 2.5 day sell-off has not affected them at all, and so they continue to drop. They are moving towards the lower areas of their chart, so they're not in oversold territory like they were when they first gave the buy signals, but they're not really in overbought territory either. Breadth has been especially tricky. A professional trader that I know has described this market as tricky, and it certainly is. Breadth was lagging badly through this entire rally. It was nowhere near the strength of the breadth of the January 2019 rally. Then, for a 6 day period, breadth was tremendous, culminating with, I believe, last Wednesday's action. And it actually drove our breadth oscillators up above where they had been in January 2019, but just briefly. And now they've reversed sharply back downwards again over the last 2 days and actually fallen back into sell signals. So if that's not tricky, I don't know what is. Volatility has also been a bit of a conundrum, but we are sticking with our long-term view on volatility is that as long as VIX closes above its 200-day moving average, that's dangerous for stocks. And despite the fact that we do have short-term buy signals from a VIX crossover system and a VIX spike peak buy signal, the fact that the long-term trend of volatility is still higher remains a problem for the market. And as we noted, in the rally in October 2008 to really January 2009, or at least November 2008 to January 2009, and other rallies in the past too, VIX remained above its 200-day moving average, and then the market eventually fell. When the crossover came, it was a much better buy point. So VIX is well above that level right now, and that remains a negative factor. The term structure of volatility derivatives is also negative. So overall, we are maintaining a core bearish position as we have been. We will trade the short-term buy signals around it, but the core bearish position is going to remain there until certainly the VIX volatility, a whole picture there improves with the term structure and the long-term trend. So visit our site, optionstrategist.com. You might be interested in the fact that we are having Saturday seminars. Our next one is on the May 16th, and it's going to be discussing advanced spreading techniques. Thanks for listening.